Hello and welcome to Mortgage Watch, your update for financial and real estate mortgage-related news. In the top of the news this week, the Federal Reserve cut their federal funds rate by another 3/4 of a point. This move was widely expected. Some people hoped it would be higher, some thought it might be lower, but it was a pretty substantial move on the Fed's part. Mortgage rates responded by going down and then going up, and they have been vacillating, as we had talked about, very large swings over the past 6 months. These continue to be accelerated. Now, it's interesting that the Feds have lowered their rate 3% since last fall, and yet mortgage rates are only really down 1/4%, which is kind of interesting. As we've been saying for a long time, mortgage rates have nothing to do with the federal rates that they set. The rates that the Feds are adjusting are rates that they lend money to banks and that banks lend to each other. And the problem with what's going on right now in the credit and financial markets is that there isn't liquidity and people are scared. Banks don't even want to lend to each other because they don't know who'll be around tomorrow. And so there's just this lack of movement that's going on. Slowly, it's starting to take effect. The Fed actions are starting to help the market. But the spread is still huge. It's down from where it was in the beginning of March, but it's still very high historically, and we are still looking for rates to come down, probably about mortgage rates about 0.75% in the next 3 to 6 months. The next topic is called Bear Stearns, Where Have You Gone? As some of you know, Bear Stearns, which was the 6th largest Wall Street investment banking house, has pretty much disappeared, kind of sold in a backroom auction that the Fed Reserve arranged to J.P. Morgan Chase. They were sold for basically pennies on the dollar. Now, any of the large Bear holders of stock, which includes their employees and very large, couple of large billionaires, are just outraged because they were sold for less than the value of their office building. The Feds took action to protect the markets because, again, if people feel that investment banking houses are going to fail, then there's going to be the same problem that we've had, which is a lot of fear about getting involved and lending money and doing the normal actions that our economy is based on. Now, another thing that the Fed did to help move things along is that they opened their federal funds window to investment banks. We've talked about this previously. The federal window is where banks, depository banks, can go and borrow money at discounted rates to enable them to do business. But the Wall Street firms weren't allowed to do this because they're not technically banks. They're investment banks. They don't really hold depositors' money. They do a lot of banking activity, but it's different than actually being a bank that takes in depositors' money. And so after the Bear Stearns change of hands and so on, the Fed opened their window to a whole bunch of Wall Street firms that can now go and borrow money there. And they are looking to encourage people to do that. It is called, in some ways, the repo market. It's a repurchase market. That means that these banks and these institutions go to the Fed with securities, with paper, and they borrow cash dollars. I'm calling it going to the Fed and exchanging flour for cash. But it doesn't matter what they have. The Fed is valuing it. It's not flour, by the way. It's only securities and investment-grade paper. But they are letting these banks get cash. And that has been the problem of our investment market so far, is that investors do not want to buy into these vehicles that they've always bought. Without that, we don't have an efficient market. There's nowhere to take mortgage loans and everything else. And so the Fed is, again, trying to get everything moving. Unfortunately, one of the institutions that can't go to the Fed is Thornburg Mortgage. Even though they're a huge provider of mutual funds and also very strong AAA-rated interest mortgage paper. They borrowed about $1 billion from 5 banks, but the bad news is they have 1 week to pay it back. So they're trying desperately to raise cash. And again, this is a very efficient operation. This isn't a company that's really in trouble, except for the fact that they can't get money in the door. They cannot get people to buy their investment-grade securities, the mortgage paper, the mortgages that they've made. They need to get cash for those in order to continue doing business. Another very critical news development, Fannie and Freddie have been given permission to raise more capital, about $200 billion. And that is probably going to be 10% of all mortgage originations in this year. They're also going to be allowed to hold more mortgages in their portfolio and have less capital, less money in order to do that. That again is just one more thing that the Feds are doing to try and move these markets forward by letting Fannie and Freddie take a bigger part. They're already a huge player, but because they are considered to be a semi-government agency, and they're really not, they're private companies, but they're considered to have the background of the United States government. So because of that, everyone feels that their paper is a little bit safer. Nevertheless, they have had trouble also selling their paper. But if they can hold more of it, they won't have to sell as much. So these are, again, things that are going to move the market forward. So the question is, where are we at? Better, same, or worse? Well, we're definitely not worse, even though the news of this week was very, very disturbing. What's happening now in this environment is it's all based on rumor. Rumors, speculation. These are human beings making human emotional decisions. And when they think something is in trouble, it's kind of like a panic that sets in. And the Federal Reserve's job is to kind of calm that panic. So we're wondering, when is the anti-anxiety medicine really going to kick in and everyone's going to calm down? Well, we think it's going to happen over the next couple of months. These actions are broad-based. It isn't just the Fed lowering the cost of money to banks and investment houses or allowing them to borrow money. It's just sending a clear signal that it's going to do what it needs to do behind the scenes to protect the economy and the market. I know there's people saying, well, we should have a hammer and sickle on our flag, that's communism and everything else. It's a free market economy. The government's got to do what it can, though, to keep things going. I know there are repeated calls for the Feds to step in and do something about all the homeowners facing foreclosure, and there is action in Congress right now to find ways to help people who could make their mortgage payment until their loans reset, kind of find a way through this mess. Because if we continue to have accelerating foreclosures, that isn't going to be good. Right now, it's kind of tapered off, but there's a whole wave of option arms that we've explained previously that are coming due for resets, and those are A-paper borrowers. If those people can't find effective ways to refinance, that's not going to be good for our markets. Of course, as you all know, Fannie, Freddie, and the FHA have higher loan limits now, so that's going to help refinance a lot of these people. There's a lot of noise about these higher loan limits. Everyone is trying to figure out how that market is going to work. So here and now, no one has actually funded a higher level loan, but it is coming. That's why we think that over the next couple of months, these actions are going to have a calming effect. The market's going to relax. There are still a lot of really good mortgages out there. The problem is that it's a herd mentality. When people start panicking, it's like a herd of cattle, a herd of anything else. Everyone starts rushing for the exits and a stampede, and the Fed is trying to calm everybody down and restore an order of rationality to the market. So that's what we're looking to happen over the next couple of months and have things calm down. Again, if you're a homeowner, you're wondering how this affects you in terms of your mortgage and your real estate, it's time to start talking to a mortgage professional or a real estate professional to get yourself ready. There probably will be refinance opportunities for everyone in the coming months. Right now, it's only been for a small part of the market, but the idea is to open that up to a larger group of people. So again, it's time to get yourself ready. In every market, there are a lot of people who wait till it's all over, and they seem to wake from some, Rip Van Winkle slumber and say, hey, it's time to refi. Well, the train left the station, a couple of hours ago. That's not the case this time. We still have some time, but I encourage everyone who's tuning in to get moving on a plan. Call a mortgage professional, call a real estate professional, and get going so that you're ready to take advantage of it. Timing is really everything, so you want to be ready to pounce and watch the market and see what's going on, and a mortgage professional will be able to do that for you. Well, that's it for this week. Thanks very much for tuning in to Mortgage Watch. We wish you a good week and look forward to talking to you again next week. Goodbye. Okay.